Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today's Thursday. It's March 30th, and it's about 7:50 in the morning. The market's going to gear up to open up in about an hour. Let's see here. An hour and 40 minutes to be specific with you. Now, today's a really, really big day. The markets are, again, overextended. I'm really nervous about putting in long positions right now because we may have a little pullback, especially in light of today's session. Now, why is today so important? What's going on today? Let's take a look here, and I'll show you right now. GDP. Now, this report comes out in about 40 minutes, so we'll have a time to position ourselves before the market opens. But this is one of the biggest, if not the biggest, report for the quarter because it tells investors exactly what the growth of the U.S. economy is, or lack thereof. Quarter over quarter, they're looking at 2.7% all the way to 3%. I think it's going to be in between. And I'm also looking at personal consumption expenditures. If the expenditures goes up to 105, that'll be really, really positive. If we can get above 106, that will show that people are rocking and rolling and the economy is moving at a faster rate than we expected, and the Fed may take action. So it's really interesting how this report may impact the economy, because right now we're in this period where too much growth is not good and too little growth is not good. We have to be right in this zone. It's like having a blood level have to be in a certain zone for certain drugs to work. It's the same thing here. We have to be at a certain range. If it's too much, they may raise rates too much. If it's too little, they may forbear or stall out. So again, we got to watch this report. The good thing is it comes out at about 8:30, and I'm hoping to have this video to you by that time so you can review it. Now, again, as I mentioned, stocks are gearing up to open hard and fast. But if you look at the bond market hasn't really moved. And remember, stocks get their directional bias from the market. And I'm fearful that this gap right here is going to get filled, and that'll create pressure on the stock market. So pay very, 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 very close attention today to how the market's going to react. Now, I almost got confused this morning. I thought it was a Friday the 31st. I was thinking, what's going on here? But it's actually Thursday. My weeks are just a little messed up right now. But stocks are set to open higher, and the GDP report is going to be the big one, and then the jobless claims. But the jobless claims, I know that Wall Street's going to make a big deal out of it, but I'm going to tell you right now, it's just not a big deal. It's not a big thing. It's been very steady. It's been holding right between 190 and 200,000 for the longest time possible. So let's not make too much of it unless it's like 250 or 280 or like 150. If it's 210, 185, it's been very, very solid. It's been actually the most solid indicator since this craziness started on Wall Street. Now, let's talk a little bit about what we can expect today. Yesterday, all the benchmark indices ended the regular session with solid gains. Risk appetite continued to rebound from the turmoil in the banking sector, and I told you it was one of those things that we can now take advantage of. I'm not hearing any more banks going out of business. It was just a drought that we had to go through. While upbeat outlook from several companies eased some worries about the economy. For example, Micron, the chip stock. This is why I closed out my short positions in semiconductors, because I was nervous the numbers were going to be good and we had a profit. So, and we followed our rules, but they're talking about a optimistic outlook for 2025. And remember, stocks and the stock market discounts everything that's known ahead of time. So if they're saying this is 25, it's already being priced into the market. Anything that's known is priced in. And if you and I know about it, trust me, Wall Street knows about it. Consumer stocks. Remember I told you consumer stocks are going to do well, consumer staples, that sector that I'll talk about in a few minutes. Well, consumer stocks were supported by the broad market. Carnival. I mean, folks, I haven't talked about Carnival since this Petri dish COVID started. I mean, it's been a mess. But they upgraded the stock to positive from neutral. Honestly, I don't know about that. I'm still on the sidelines there. Regional bank stocks gained ground as fears about a contagion continued to ease. First Republic, Lincoln National, they both rose over 4%. At the same time, Lululemon surged 12%. Remember, Lulu was my favorite. Crocs and Lulu were my favorite two consumer stocks during COVID period. And I told you they will be back. And boy, oh boy, Lulu is back. Although I am very fearful because they're such a good company. They've got a lot of copycats. Costco, who else was telling me? I remember Lance telling me that Costco has stuff that looks like them, and Target and Costco are trying to copy or sell things that are very similar. I don't know what kind of an impact that'll have, but I imagine it would have quite a big one because Costco and Target are such big companies, and they have so much capitalization and clientele. And I'm sure if they're doing it, other companies are following in that same footsteps. But athletic gear is starting to get a little saturated. So Lulu really has to do something new or different. Otherwise, it's just going to become another company. But we'll see. They're fairly new, and there's still a lot of meat on those bones. On Wednesday, yesterday, we had U.S. pending home sales. They stood at 0.8 million, stronger than expected, up from 2.3 negative, rising for a third consecutive month in February. But they're still way below last year's level. I think last time I checked, I don't know what this number was, but it was like 25% lower. Meanwhile, the Fed's interest rate trajectory continues to remain in the spotlight, and this is really interesting. We've got a 58.7% of a no rate hike and a 41.3% chance of a 25 basis point hike. Now, if you listen to the Fed, aka Mr. Squirrely, as I like to call Powell, it's kind of interesting because a few weeks ago, the odds were 58% we were going to go to a 25, and 41% we're going to do nothing. Now the odds have shifted. So the market, and I'm telling you this, and I was telling you this last week, this market does not believe that Fed is going to raise rates next meeting. Otherwise, the 2-year wouldn't rally like it did when Powell spoke. So the markets do not believe there's going to be a rate hike. It'll be very interesting to see if these numbers get switched over after today's report. Today, all eyes are on the GDP, not in a couple hours, but in 33 minutes. Economists believe the GDP will stand at 2.7% in fourth quarter compared to third quarter of 3.2%. Jobless claims, as I said, they are looking to be near the 190 to 200,000, a nothing burger. And then we've got Boston Fed President Collins and Barkin for fresh clues on the outlook. Now, every one of these Feds has been extremely transparent and straightforward, except for Squirrely. So it would be very interesting to hear what they have to say. And investors are going to be looking for clues that the Fed may not raise rates because that's what the market's discounting right now. And we never want to argue with the stock market's price action because the stock market's always right. In Europe, futures are up this morning, hitting a 2-week high as a surprise profit by Swedish fashion retailer H&M. You see them in every mall. They're a low-priced retailer. Easing concerns over banking sector boosted investor confidence. Well, it's the banking sector. I think the whole fiasco is behind this. Look, it was a mismanaged bank. It's just that simple. And there was a couple of concerns about it. It's behind us. China closed higher as promise of more stimulus supported Chinese stocks, while market participants awaited crucial business activity report, which will be coming out overnight. So at night or later tonight, our time, because China's time is obviously different than ours. Japan's Nikkei stock closed lower as investors locked in profits after recent gains. I don't have a good feel for the Japanese market right now, and honestly, I don't even think they do. R&H is coming out with some numbers. They had downbeat results. Viking Therapeutics is coming out with numbers. PacWest Bank is coming out with some numbers. And we have earnings on BlackBerry today. That's the only real stock that grabbed my attention. Now, looking at the S&P 500, this is the channel we've been building for quite some time. It looks like we're heading back to the upper edge of this channel. Now, momentum levels, as I'll show you right now, for the whole S&P 500 are actually starting to turn. And I told you they would. I told you we were going to start bottoming out here and going back up. So let me go to weekly. And we are, in fact, doing that right now. So keep your eye on the SPY. We may see some more upside. Now, the Russell 2000 is not as excited as the SPY. Large caps are actually leading ahead of small caps. That's the first time that's happened in quite some time. And I don't know if it'll continue. But weakness coming into small caps is not that great because small caps is what leads the market on the way up and on the way down. The Dow is starting to come back into that range-bound price action. This is all the banking stuff right here. This is all the banking craziness, and I told you it would get washed out, and we would come back up. This is a very positive sign because today's the first day, or maybe the second day, that we're entering that choppiness. So it looks to me like the market is starting to forget about this banking fiasco, and markets have very short memories. Semiconductors are breaking out, but you got to be really, really careful here because tech is a little bit overbought, and I'm not 1,000% sure that the Fed is going to not raise rates. Now, if they're not going to raise rates, it'll be very beneficial for chip stocks, and chip stocks are starting to do well again because it's a commoditized industry. But keep your eye on it, and I'm very skeptical that we're going to break out here. You will see that technology is doing the same thing. And again, I'm very, very skeptical that this will sustain itself because we're still not out of danger zone yet. And it's just that simple. So there's a good chance we're going to hit some stops here, especially Friday when the algos come in. They hit the stops and then they take us back into the range. So be really, really cautious. Now, one sector that I'm really liking, and I've been talking about it nonstop, is consumer staples. Consumer staples are doing great. And if you look at consumer staples over time, you will see that now 64% are trading above the 50-day, 58 are trading above the 200-day, and the trajectory seems to be moving higher. Now notice consumer staples is the only green one at the 50-day. Now I told you about this about a month ago, that consumer staples are going to be coming up. Also, I think energy stocks are going to start coming up as it looks to me like they're starting to bottom out right here and start coming back up. You see that? That's big, big, big right there. So I think we're going to see some more upside in energy, consumer stocks, and I think we're going to see some pressure in other stocks. Looking at each individual sector, remember, today's Thursday, I give you my top ETF and option pick. Looking at the market as a whole, financials are just not looking all that great. They need to break out above the 32, let's say 32.40 level. Then it'll start looking at them. I'd actually like to see them go above the 33 level. But financials are going to go up. I'm already seeing that in the energy sector. I'm getting confused. And utilities, they're starting to move, but I'd like to see it to go above the 68 level. Consumer staples are rocking and rolling. They're entering this resistance level, but based on the momentum levels, I do think they're going to break out, and they are right now the strongest sector in terms of where momentum going aside from technology. Industrial stocks are rocking and rolling. Look at that. They broke out above their resistance level right here to the upside. Healthcare is not doing all that great. You got to be really careful with healthcare. Communication sector, be very, very cautious. Consumer discretionary, be extremely cautious because I think it's topping out right here. Real estate, it's a question mark. And basic materials are following industrial. So in terms of sectors that I'm really liking right now, I like the energies a lot. I like consumer staples a lot. I like technology, but I'm very risk adverse with technology right now because it could turn on a dime. I don't like healthcare. I don't like communication services. I'm not a fan of consumer discretionary. Real estate, big question mark. I like industrial and materials. So as far as sectors that I really, really like energy. I like consumer staple. I like industrial. I like basic material. I'm question mark with technology just because it's, we don't want to fade a strong trend and lose this opportunity. But communication services, consumer discretionary, real estate, and healthcare, So be cautious. Now, as far as where would I put my money if I was trading right now, it would be clearly consumer staples. And let me just show you consumer staples. I think consumer staples is great because here's the thing. If interest rates go higher, they're inflation proof. If interest rates go lower, they'll get a boost from the broad market. So the way I'm looking at it, there's just not much downside in consumer staples right now in comparison to other stocks. And look at where we're at. We just broke out of a, let's see here, about a month and a half high. So this is great. This is really, really good. And again, we're not overbought like we are in technology. So there's more upside potentially in the consumer staples sector. Now, if I were you, I would right now wait for a little pullback, or maybe we'll get one today, but I would wait for a little pullback, and then I would go for 50's not enough. Let's go 78. Yeah, 78 days. Remember, this is not a day trade or a swing trade. And by the way, implied volatility is not all that high either. So that's a great thing. It's trading at about 74 right now. So you can go and don't look at these because the market hasn't opened yet. So these bid and offers are totally off. But you could see right here what the last trade is. And you can probably get the 74 for between 2 and 250. assuming the market doesn't open much higher. 75 for 158. The bottom line is I would go with either the 74 or 75 expiring January, February, March, April, May, June. June 74 or 75 and hold on to those for a little while and maybe wait for a little pullback. We may get one after the GDP comes out. I don't know, or we may get a rally. But we got to be really, really cautious right now. Now, folks, before I let you go, Lance Ippolito. Lance has been on fire, man. That guy is just hot. He's been working on something behind the scenes for a while, and it's finally ready for the grand reveal. It's a brand new option scanner, and really what makes it different from anything he's developed is its ability to only show opportunities that he's willing to consider for trading. Because, markets have a lot of noise, and if you can isolate something with a scanner, you're so much better off than doing this, just looking at all of these. It's just too much data. And it only shows opportunity that are primed for trading. In other words, it filters out everything that's not worth the time or money. Exactly, because Lance doesn't have he's a busy guy. He doesn't have time to mess around with 50,000 charts or anything like that. Now, Lance is watching it spit out opportunities on First Republic Bank, Mattel, Google, Tesla, just to give you some ideas of what he's looking at. Now, he's about to reveal how the scanner works in a very special live training session that's happening at 1 p.m. Eastern Time today. Now, remember, it's Wednesday. It's Thursday, the 30th. This date is from yesterday. So today is Thursday, the 30th. I almost got confused and thought it was Friday. Can you blame me? Follow the link below. Live, all new, brand new. You don't want to miss out. Free presentation from Lance at 1 p.m. without any monkey business. Follow the link below. It's in the YouTube Wealth Press channel, or if you're watching on the Wealth Press page or in the Roger Scott channel, whatever you're watching, it's usually below the video. But if you go to the YouTube Wealth Press channel, there's a link to a Telegram channel. Subscribe to it, like us, and post comments, and I will respond. Yes, I actually respond, and I will talk to you guys later. Have a great day. Don't forget, 1 p.m. Eastern Time, Lance Red Hot, Thursday. You don't want to miss it today. What else you got going on at 1 p.m. after lunch? Right after lunch, 1 p.m. Eastern Time. Don't miss out. Thursday, the 30th of March. Bye, guys. Have a great, great day.